let's talk about the types of funding. Funding is the capital that a bank has. Every time that someone makes a deposit in a bank, they're contributing to their funding. But not all funders are equal, and there are different costs as well as consequences, for example, for liquidity. So let's take a look at these different types. In a bank's business model, it must obtain funding, that is, the capital for the bank, which is what it uses to lend against. For example, if we say that a bank is holding 300 billion and they use that money to lend or to trade, those 3 billion have to come from somewhere. In here comes the concept of maturity transformation, which is the following. Banks always take short-term deposits and turn them into long-term loans. The ideal situation would be for deposits to have the same maturity as loans. So if you have, for example, 2 billion in 1-year deposits, savings accounts, for example, you would have 2 billion in 1-year loans with the exact same quantity of capital. Or if you have 500 million in 10-year deposits, you would have 500 million in 10-year loans, and so on. Ideally, they would be the same, but it's not always possible because deposits are always a little bit shorter in term than the loans that they back. So that process is maturity transformation. The short maturities of the deposits are transformed into long-term loans. And you will see this come up very frequently in terms of banks and funding. In terms of funding itself, or in other words, the people that actually deposit capital in a bank, there are usually 5 major types. The first are retail deposits. These are the most common method and the cheapest one. It's people and businesses who have money stored at the bank, period. If you have an individual bank account, you are a retail depositor. And these are especially profitable if they are non-interest bearing. For example, if you have one person with $50 in a checking account that receives no interest on that, and you lend those $50 at a 6% interest rate, that's profit. But if you have that depositor with those $50 in a savings product with a fixed interest rate of 2 or 3%, your profit will be less. It's the difference between the interest that you charge and the interest that you obtain. If you multiply this by thousands of depositors, you can see why paying the least interest possible on deposits is profitable. And we'll cover the key performance indicators in their own lesson, but one of them is the NII, or net interest income. It's called net because it's the amount of interest that is obtained minus the one that is paid to depositors. So the less interest the bank pays on deposits, the higher the net interest income. Then we have wholesale deposits, also known as capital market deposits. Everything that's bought wholesale is in the capital markets, and these are large volume deposits from other banks or institutions, such as pension funds, mutual funds, and so on. So if you invest in a mutual fund that returns 2%, maybe a big part of that money is actually deposited in the bank with a 2% interest rate. And naturally, these are higher volume. So you may have, for example, instead of 10,000 people that each have 1,000 in their accounts, resulting in 1 million, in this case, you have one pension fund depositing that 1 million. Out of curiosity, this is a dangerous type of funding because just one institution can take out their whole deposit and the bank's capital can be threatened. It's very hard for those 10,000 people to all take out their money at the same time, but it's very easy for one institution to do it. Then we have wholesale debt. It's very similar to the deposit, where the institution places money in the bank and receives an interest rate. But in this case, it's not considered a deposit, it's literally considered a loan to this bank. It works similarly in practice, but it has a higher interest rate, and it's commonly received from other banks or institutions. So instead of having 100 million from a pension fund earning 2%, The bank may borrow 100 million from another one and pay 5% or more. And then we have equity. It's literally an equity investment. For example, a very big bank or high net worth individual coming in and saying, hey, give up 40% of the bank and I'm going to offer you 2 billion in return, for example. So the interest charge that you pay to have this money is a KPI in banking because it affects a metric called the net interest income, as stated. We'll cover this later, but the mathematics are simple. The net interest income is the interest earned minus the interest paid. So the more that you pay for deposits, the less net interest that you earn. That's why retail deposits are so popular. Individuals are the ones that get paid the less for their deposits. And that's why most bank advertisements are for retail customers. So naturally, the funding cost of a bank depends on the different sources of funding used. And the larger that the bank grows, the harder it is to define precisely. What I mean by this is the following. If you have a very small bank, it's very possible that they only take retail depositors. And even then, it's already hard to calculate because interest rates are usually floating, so they change as the interbank offered rates change, such as the LIBOR or Euribor. But now imagine if the bank is very big and has multiple sources of funding, maybe 200 million from a pension fund, maybe 1 billion from another bank, maybe 2 billion in retail deposits. So this becomes very complex to estimate. And naturally, as retail customer deposits are usually the least costly source, or saying this in other words, they're the people who get paid the least because they're usually small folks that have no negotiating power, and also because they're less likely to provoke a run on the bank. In other words, like I mentioned, it's a lot harder for a collective of individuals to take 1 million from a bank immediately, but it's very easy for one pension fund to take out 1 million. They just need to do it. And this causes most banks to have a tendency to chase those retail deposits. And again, that's why most banks have advertising that caters to individuals. But there are several considerations to take into account here. The first is what is the customer demand for fixed rate products versus floating ones? If you know about the basics of that, you know this by heart. So the interest rate that's charged can be fixed or floating. If it's fixed, for example, 5%, that's what you earn or pay, depending on whether it's a deposit or a loan, but it's fixed. If I have a savings account that earns 5%, that's what I earn, period. But if the interest rate is floating, then it changes depending on currencies or the interbank offered rates, such as the LIBOR. Now here's the key. As you're guessing, people want fixed rate deposits because if the interest rates lower, for example, from 5 to 2%, what they earn on the deposit changes as well. But if they have a fixed rate, that doesn't affect them. But as you're probably guessing, fixed rate products are exactly what the bank does not want to provide because they want to push the risk of the interest rate changes on the customer. So it depends on how aware the customers are of fixed rate products and how much bargaining power they actually have. And this varies by country or even region. Another factor is the priority of the bank, their business strategy. Are they looking to expand market share or to capture profits? Because if they want to capture profits, they will give out very low rates on deposits. They want to maximize the interest earned. But if they want to expand their market share, for example, to be competitive and attract depositors, for example, in a new country, and in the future, they may switch tactics, which can influence those products. The availability of operations also comes in here. Many banks provide deposit accounts with higher interest rates if the person only makes transfers and movements online and not on branches, because that means less human capital efforts. Or for example, higher deposit rates if they use their credit card, because the bank gets commissions from Visa or the other card companies. So all of these influence the rates of deposits for the funders. What are our examples here? The first are fixed-term deposits, and this is having funding locked in for longer periods of time. For example, a 10-year savings account. This helps match the maturity of long-term loans, and banks love these deposits, which is why higher interest rates are paid on these. This is because with a fixed-term deposit, there's no danger of a depositor taking out a lot of capital and disturbing that maturity gap between deposits and loans. But if it's a checking account with a lot of money, then if that deposit is withdrawn, the bank needs to rebalance itself suddenly by trying to liquidate a loan of the same maturity or using instruments to hedge. Then, banks pay higher rates for accounts that can only be accessed through digital means, web or mobile, no branch service. This is because it saves in operational costs. You need to pay less salaries to branch employees if customers just don't use them. And this is also a reason why digital banks are so popular, because they have a lower barrier to entry, since they don't need to pay salaries or even office rent on the branches. And finally, remember that as part of the maturity transformation process, the ideal would be that every time a bank obtains or loses funding, they would hedge against that mismatch in the funding and lending. For example, if a bank suddenly obtains 1 million in 3-year deposits, they need to lend 1 million more in 3-year loans to balance that net interest. Or if they lose 1 million in 1-year deposits, they should liquidate 1 million in 1-year loans or reobtain 1 million in 1-year deposits. They can also use capital market instruments to hedge against this gap, as we'll see later. What are our key takeaways here? The first is that there are usually 4 main sources of funding for a bank. The first is retail deposits from individuals, which is the most cost-effective one. Then, wholesale deposits from institutions such as pension funds. Then, wholesale debt from the same institutions, which is similar to a deposit, but the bank is paying more interest for it because it's literally a loan. And holding equity in return for capital. For example, a bank buying a portion of another bank in return for funding. Then, retail deposits, also known as customer deposits, out of all types, are the cheapest to obtain. And due to their volume per client, they are the ones less likely to disturb the funding to lending maturity balance. Or in other words, retail customers are the ones that are paid the least interest. Then, there are several considerations that affect the interest rates paid for customer deposits. These include how demanding the customers are in terms of fixed-rate products, whether the bank is aiming at profit or market share strategically, and so on. So as we see, there are several types of funding for banks, but banks usually prefer retail funders for 2 reasons. Because they invest low amounts of capital, they're less likely to cause a run on the bank. And on the other hand, they're the ones that get paid the least, so banks love this type. But the other types, naturally, are also available, with different consequences for the liquidity of that funding.